Of course, the thing that is underlying all of this push when it comes to the Fed, the tension at the Fed, has to do with inflation. That's what Myles wrote about in this morning's morning brief. And, as I was reading the morning brief, Myles, I have to say, I was reminded of Brian Sozzi and an exchange that you guys had in the last couple of weeks where Brian talked about the upward pressure on prices and how that was going to be problematic for Americans. And you said, yes, but it's transitory. It's going to go away. But in your note, as you talked about, there's now this sort of duration versus magnitude debate. And maybe not for macro and for Fed, the magnitude doesn't matter. But for individuals, it matters on sort of a day-to-day basis.
Well, okay, yes, sure. But the conversation is about how it changes Fed policy. So again, I think we're trying to continue to tease out what Fed speak does and does not mean. And I just sort of felt, especially after the comments we got from Jim Gorman yesterday, CEO of Morgan Stanley, and then we see Carl Icahn this morning in a Q&A with Bloomberg. He's asked about inflation, and his take is basically, yes, I see inflation. Like, his justification for inflation is, I believe there is inflation. Gorman's justification for why the Fed is going to raise rates earlier than expected is because he thinks people are now talking about inflation more. But that is not the conversation the Fed is having. The Fed is saying inflation pressures are going to be transitory. Transitory means non-permanent. That's a time-based judgment. They mean inflation pressures are going to show up over, they'll call it the medium term. So let's say over the next 6 months, inflation pressures will be elevated. But those prior comments that we're taking from Wall Street folks, and I think we can hear them from executives, and yes, I think you'll hear them from people as well. Those are magnitude-based comments. The Fed's point on transitory pressures on inflation does not need passe judgment on how high prices or by how much prices will rise. Prices could rise by 3%, 4%, 9%. All of those are in excess of the Fed's 2% target. But the Fed believes that they will rise at that level, whatever that level may be, for a fleeting period of time. And so until the Fed is convinced that those pressures will not be temporary, and you already can see the price of some commodities. Look at lumber has come down. You see corn coming down. Wheat is coming down. So some of those pressures are easing just a little bit. Used car sales, they continue to be on the rise, but it's a very well documented issue right now of demand outstripping supply in that specific market, which is dealing with supply chain issues related to the chip shortage, related to shipping constraints. You look at how difficult it is to move things around the country on freight or on trains right now. There's just not enough supply to meet the demand, which is leading to these price pressures, which again, the Fed believes will be transitory. Now, part of kind of what jogged this for me today, and again, this might all be wrong, but this is how the Fed is thinking about it. They're making a time-based, not a magnitude-based judgment. This chart, which we show from Deutsche Bank, shows that the magnitude, guys, of inflation surprises has been unprecedented. And I think that because inflation is rising so much faster than expected, it is causing a confusion between the two concepts, that the magnitude thus passes judgment on the time. And I know this is a little, this sounds kind of like mealy-mouthed Fed defending, but this stuff matters, because if you believe that inflation pressures are going to be indefinite and they indeed turn out to be fleeting, I think you could find yourself, on the wrong side of market moves. You could be bracing for a more hawkish Fed when indeed they will be more dovish. And, I think this is another important outline, and I'm sure I'll revisit this topic as well as we get through the summer. And we know, guys, that there's going to be some hot inflation prints that are going to cause a lot of consternation and a lot of discussion around whether transitory is indeed what it claims to be.
Myles, how would you define transitory? How many months is that?
I think the Fed right now is talking about inflation pressures cooling in the second half of this year. Technically, the second half of the year starts in July, but I think once you get into, say, October, November, you might see some of that, cooling off. Certainly, you look at, let's say, what's happened with the price of oil. So, that feeds into the price of gas. I mean, that's been elevated now for the last 6 months. And Sazi, you look at the value trade, right? That really kicked off with Biden's election, and I think more importantly with some of that early vaccine data we got from Pfizer. So that's November, right? So the comps year over year start to get a little more favorable for a lot of those inflation inputs starting around October, November. So I don't think the Fed is going to be reevaluating its position on transitory until the beginning of 2022. And so I think that's why we're kind of all braced for like 7 months of debate here.
Fun times. I look forward to those 7 months of debate, I guess, Myles.